Voltaire, an 18th century writer and philosopher, once said, "History never repeats itself, man always does." There may not be a better example to support this quote than investing. Market bubbles occur when prices become disconnected from reality. This can happen for a number of reasons, but in order to really understand bubbles, we have to understand human behavior. Because after all, markets are a human invention, and they rely on supply and demand, something that we determine. Bubbles can either be market-wide, impacting all investments, or concentrated, where it's isolated to a specific company, sector, or industry. Bubbles that are market-wide are more of a natural process of investing, as the pattern follows a pattern similar to the business cycle, featuring periods of expansion and contraction. It's often impossible to avoid having exposure to market bubbles, and the truth is, we don't have to. Concentrated bubbles, on the other hand, should be something to avoid as they often create more destruction than benefit for investors. They are often focused on a single company's stock and really leverage the idea of FOMO, or the fear of missing out, to trick people into thinking that they're investing, but in reality, they're gambling. Shane Parrish describes bubbles as the following, from the Great Mental Models Volume 4, Economics and Art. During the early stages of a bubble, many fortunes are made, but as knowledge about sharply rising prices spreads, more people enter the bubble on less favorable terms. Often bubbles become truly divorced from reality once growing numbers of people who are far outside of their circle of competence start buying. People end up buying on the mistaken assumption that the immediate past is an accurate picture of the immediate future. There is a contagious optimism, seemingly impervious to facts, that often takes hold when prices are rising. People don't understand the economics of what they're buying. They just don't want to miss out on the gold rush. One of the very first bubbles, and oddly one of the strangest, is tulip mania. We need to go back in time to 1593 Holland, when tulips were first introduced to the region. With most new things, there was excitement around the flowers, and they quickly became a status symbol for the wealthy. But again, just like most new things, the excitement wore off, and they became affordable so more people could own them. The real craze started 40 years later, when the flowers were infected by a virus that caused the petals to develop unique and contrasting designs. The more elaborate the design, the rarer and more sought after the flower became. I call it a craze because it truly was. At its peak, people were taking out loans, selling their possessions, even trading valuables like land and houses for tulip bulbs. Eventually, prices got so high that sellers simply couldn't refuse to sell. As more and more people wanted to sell, prices began to fall, and then to crash. In almost no time at all, tulip bulbs were virtually worthless, losing 99% of their value in a matter of months, which might not seem like a lot of time today, but back then, without the technology and communication that we have now, it was incredibly fast. In 1720, a new bubble formed around the South Sea Company. They were given exclusive rights from the British government to the seas of South America and all the riches that came with it. Everyone viewed this as a deal of a lifetime, and when shares were offered by the company, they were quickly swept up. So they continued to offer more shares, each time selling as quickly as the last, but each time for much higher prices. At its peak, the South Sea Company was valued somewhere around $4 trillion in today's money, which would make it the most valuable company today. The SSC ended up not being as prosperous as people originally hoped. And once it was figured out, there was a massive sell-off, causing the stock to fall, then crash, until it was eventually worth less than it was before all the buzz, collectively destroying all the wealth it built, and then some. Sir Isaac Newton, who we all know as the incredible scientist, but lesser known is that he served as the warden and master of the Royal Mint for 3 decades, was also swept up in the craze, and reportedly lost would have been the equivalent of millions of dollars today. It's reported that he bought in a number of times on the way up, not wanting to miss out while everyone else got rich, and ended up losing it all. Even he wasn't immune to FOMO. And he was quoted saying, "I can calculate the motions of heavenly bodies, but not the madness of people," which is a very revealing observation from one of the smartest people who have ever lived. If we fast forward to the past 100 years, we see similar patterns. The bubble of the 1920s was fueled by the collective belief that the US economy was unstoppable, and prices would go on forever. The popping of that bubble led to the Great Depression, a 3-year decline where most blue chip stocks lost over 95% of their value. The Tronics boom of the 1960s and the dot-com bubble of the early 2000s shared a lot of similarities. Both bubbles were fueled by a new technology, resulting in some of the largest movements of companies going public, with some of those companies changing their names to sound more techy, and an excitement that these companies could only go up in price. In both cases, these overinflated bubbles popped, resulting in huge destruction of any wealth created. During the dot-com bubble, most of the companies didn't survive. Even Amazon lost 98.7% of its value. The Nifty 50 of the 1970s revolved around 50 companies that were believed to be so solid that they could never fail. People were willing to buy at any price because it didn't matter if they only increased in value. A similar logic inspired the 2008 financial crisis, with home prices increasing at astronomical rates and the belief that houses could only increase in value. The Nifty 50 ended with prices getting too high not to sell. With sellers flooding the market, prices collapsed. In 2008, as housing prices started to cool, many Americans began defaulting on their loans as they were stuck with a mortgage balance higher than the house was worth, leading to a collapse in the housing prices and any securities that were tied to them. Banks went bankrupt, and investors lost confidence, which led to mass sell-offs. Bubbles happen for different reasons, during different periods of time, to different people, and in different places. But the behavioral patterns in every case are nearly identical. It typically always starts with excitement and endless promise over something new. This gets people excited, increasing demand, and the more people that want something, the more people are willing to pay for it. This can go on for a period of time where more and more people and more money are being swept in. Eventually, though, there is a realization that what has been going on isn't sustainable. It has to end at some point, so they might as well cash out. And once people realize it, everyone tries to sell. This floods the market with supply, drops demand, and causes the price to plummet. At that point, it basically becomes a race to the bottom, with no one wanting to be the one owning shares in the end. Of course, there are people who make a lot of money during bubbles, but they essentially have to get lucky enough to spot a bubble before it's even a bubble, and sell at a high before it pops. Bubbles can expand for years, or start and finish in a matter of hours. So it's more about getting lucky than anything else. Remember that luck is not something we want to count on as long-term investors. If luck is your primary strategy, you might as well just buy lottery tickets. In The Random Walk Down Wall Street, author Burden G. Macchio writes the following to end the chapter titled, The Madness of Crowds. The constant losers in the market, from my personal experience, are those who are unable to resist being swept up in some kind of tulip bulb craze. It is not hard to make money in the market. What is hard to avoid is the alluring temptation to throw your money away on short, get-rich-quick, speculative binges. It is an obvious lesson, but one frequently ignored.